Right now, here's David Asman and Elizabeth McDonald.
Well, Ben Bernanke was right. We are definitely in an uncertain environment. Yesterday, the Dow was down more than 100 points. Today, we're up just about 200 points.
Yeah, you need a Dramamine in this environment. Bernanke's assessment of an unusually uncertain outlook contrasting with Dow members Caterpillar, 3M, AT&T, all boosting their forecasts.
We're going to get to hear if this holds when Microsoft, Amazon.com, and American Express report earnings. That's just moments from now.
Now, what to make of all of this? We've got Axel Merck of Merck Investments, Pat Becker of Becker Capital joining us with our Bulls and Bears panel. Mike Norman, Scott Martin, Nancy Skinner, and Todd Schoenberger. First to you, Axel. What do you make of it?
Well, yesterday people were reading that lengthy written report Bernanke had made, and they were looking at it yesterday, and today they're actually reading it. He spends all this time about the exit strategy, but people are talking about QE2, quantitative easing path 2, that has to come down the road if Bernanke wants to be ahead of the curve and prevent deflation. Now, we are not in that camp. We don't think they should do it, but more likely than not, if the economy weakens further, he's going to print us out of this, and that's what the market likes for the time being.
Well, Pat, in fact, the Fed futures rates yesterday didn't see an interest rate hike until the fourth quarter of 2011. That means almost 3 years at 0% interest. Isn't that a concern?
We don't see the double dip, and we don't see interest rates going up anytime in the near future. So we think we're in this kind of period of time where the bottom line of many of these companies is going to look pretty good because they're going to contain costs. And the big question is, are these companies going to return that cash that they're building to shareholders?
Todd, here's the thing for investors. You know, we had this information coming out of the Federal Reserve last week that we could be in this slow-moving environment in the weeds for another 5-6 years. Does this mean that we're going to be range-bound in, say, a 10.3, 9,500 range? I mean, what do you make of that, given all the disconnected kind of thinking coming out of D.C. that we're on a recovery path, and then you have the Fed saying, not so fast?
Yeah, you're right about that, Liz. And yes, I do think we will be range bound, but we're probably going to trend lower, at least in the short term. There's just nothing out there right now, and it's as far as that can substantiate these types of gains that we saw today. I mean, you have poor outlooks actually. They're coming not just from Washington, but also from the Fed. I mean, here you had Bernanke yesterday talking about unusually uncertain times they're looking forward, and he's going to do something. He did exactly what the markets wanted yesterday. He threw in a little bit of policy juice. He talked about what he can do, or that he will do something if he needs to. That was enough to send the markets higher today.
Okay, by the way, once again, we are reminding you that Microsoft, Amazon, a whole lot of earnings are just about to come out. As soon as they do come out, we will bring them to you live with the expert analysis coming up as to whether you should buy them tomorrow morning. Scott, there is a downside to having low interest rates. Usually the markets love low interest rates. That's normally what makes the markets pop. However, for 3 years, 0 interest rates, and it really makes you pay a penalty for saving money. We have, I think, a 2-year yield, yield on a 2-year Treasury is now 0.55%. What is the downside to all this?
Well, David, there's a couple of them. I mean, holding treasuries, like you mentioned, especially the 5-year, I kind of refer to that as going broke safely, right? Because you're going to lose money over time against inflation. But I will tell you, David, the plus side of that is, though, when we fund all this debt, all this long-term debt that we have out there that we all complain about, it's actually at 40 to 50-year lows as far as costs. So the borrowing kind of works for us in that sense. But I will tell you guys that, interestingly, if you look at the 10-year note today, barely even moved. And the bond market is telling us something, whether it's deflation or that another fall is ahead, and I think that's a concern.
You know, Mike Norman, we've got, I think, a pitted battle between the rainbow spotters who say, you know, we've got this great recovery going on. Then we've got the bear watchers. And then, backdrop to all that, we've got nearly $1 trillion in cash on the balance sheet at the non-financials. You load in the banks, you get, as David's pointed out, nearly $2 trillion. Won't the market be spring-loaded forward once the regulatory coast is clear?
Yeah, it could. I mean, it is a question of confidence, but, you know, and anyone who was watching Bulls and Bears last Friday, I said to buy that dip when it was down 275 points. I think there are some positive things building sort of behind the scenes. I mean, one, you could go back and look in May when this downturn began, and that was the end of the unemployment benefits that hit 2.5 million people. That will resume now. Congress approved the extension of unemployment benefits. We're starting to see a little bit of a pickup in lending. We're seeing that from the bank data that comes out every week, so that's a positive thing. And the dollar has come down a bit, which should help U.S. companies, manufacturing companies, and boost exports. So I think that's what is keeping the market bid here. And you're right, Liz, if we get any sort of an improvement in sentiment, I think it could take off.
All right, I don't mean to be doom and gloom around here, but Nancy Skinner, the fact is that, you know, housing sales are still very sluggish to nil right now. People are not buying houses no matter how low these interest rates go. They're now down to 4.5%. They could, even if they go down to 3%, people won't buy houses if they're not sure whether they have a job in the future. It all comes down to jobs, doesn't it?
Well, David, you're right. I think that Bernanke cited housing as really the big dark cloud over his otherwise really good forecast. He said moderate growth, we're going to look at slow gains in employment and low inflation. So that environment is good. Housing was the big question mark there, which begs the question, did we stop the housing, the $7,000 tax credit for housing a little too soon? Because if that is the only one area that we're having trouble with, perhaps we need to consider reinstating that tax credit for home buyers to get that sector. Other than that, it's a slow recovery. Everyone wants a robust one. We want our bubble economy, but we know those don't last. So it's take a deep breath. Everything looks pretty good.
All right, Axel, you know, I want to return to you. I'm hearing constantly from business CEOs that they're tired of the magical mystery tour they're being put on by Washington, D.C. with all the regulations. I mean, we get it. We needed reform. We understand that. But look, at 350 new rules still need to be written for financial reform. Businesses fearful that these rules are written in pencil and not in ink. Is that what's going on?
Well, I don't know. It seems like Fox seems to be all for these things. I listen to Mike. He wants to have more unemployment benefits. I listen to more subsidies for the housing market. I mean, what is this? Let's move to socialism 101 here.
Well, that's ridiculous.
The reason this market
here he goes with his standard.
The reason this market isn't working is because we have not allowed the housing market to come down.
No,
and now
that's
the
ridiculous.
government has an adjustable rate mortgage for the country. Of course, we can finance this as long as interest rates are low. But let interest rates go up, and we're in deep trouble. And right now, sure, the housing market went up forever, and so we can finance our interest rates also forever, our expenses.
Look,
this won't work. We will have a big problem if the economy slows down. This Goldilocks scenario about this economy just hanging in might not work in practice. Right. It's either going to move to the upside or downside.
Mike is going to be with us the whole hour. He'll have a chance to answer, but Pat is a guest here. Pat, to you and the question of housing. I mean, it is a big question. We have interest rates at historic lows, 4.5%. We hear rumors that the Fed and the Treasury may try to drive rates even lower, but that's not going to move the inventory. It's the free market that's going to move the inventory of housing, correct?
Yeah, this recovery is not going to be housing related. There's a 9 million home overhang. You've got 1 million new buyers net coming in every year. We're 5 years off from talking recovery in the housing market. In almost anything they do, I don't think is going to have an effect on it. So it's going to be one of these recoveries. It's going to be on the company side. You're going to see profitability go through the roof, which we are seeing in some of these earnings, and you're going to see that cash go on the balance sheet. And then what's the catalyst from there? Is it the companies return it to the shareholders, or do we see private equity and mergers and acquisitions? And that's what we think possibly could happen down the road. Well, but it's a slow growth economy.
It sure is. Pat Becker, Axel Merck, we thank you both. We're going to see our panel more in just a minute. Meanwhile, Treasury. All right, thank you very much, Robert. And again, those Microsoft numbers are looking pretty good right now. Yeah. After hours, trading a little bit higher. The whisper number had been a little bit higher than the original estimate. So, in fact, coming in right about where most analysts expect. As you can see, the bid and the ask is pretty close to where it closed.
Yeah, we got the Bulls and Bears panel. You know, I got to ask you, Scott Martin. Amazon taking a pounding, and this comes after a day we had 3M and AT&T basically beating expectations, Apple roaring ahead. You see Microsoft coming in. Is this a market where we're just going to see some laggards and we're going to have a good second half?
It's really lumpy, Emac. You're right. And, you know, Amazon's one of those stocks that either really blows out numbers or doesn't blow them out, right? And it moves wildly after hours. And Emac, it reminds me of Google, you know, a couple days ago, where Google had a beat on the top line and a drop on the bottom line. And so it looks like Amazon's maybe having a little trouble in the same sense of controlling some costs. And so you're looking at the stock get hit pretty hard in the aftermarket.
By the way, we should mention that usually they release right at 4 o'clock Eastern time on the button. This time they delayed it. Seems like they knew a lot of the bad news was cooked in. Nancy, I'm just wondering, is this all about the iPad taking on the Kindle, or is it about books? What is it?
You know, David, I think what we're seeing is that